Hi everybody, welcome to everyone's table. I am CAV Vivek Rajan. Thanks for your response to the earlier two videos. Today we are going to see about section 115 BBI, specified income of certain institutions. We are going to see this section 115 BBI in two parts, and today we are going to see in part 1. So what section 115 BBI talks about? Section 115 BBI talks about a scenario whereby an income arises to the trust in 7 different scenarios. In simple words, there are 7 different scenarios in which an income arises to the trust, and section 115 BBI says that in those 7 scenarios it will be taxed at a special rate of 30% without any basic exemption limit. So let us take a deep dive into the 7 scenarios that are laced with practical examples. Scenario number 1, shortfall in applying 85% of the income, where the income accumulated is in excess or set apart is in excess of 15%, and where such accumulation is not allowed under any specific provisions of the Act, and Form 10 is also not filed. In that case, then the income generates. That is the scenario number 1. Scenario number 2, where there is a deemed income referred to in explanation 4 to the third proviso to section 1023C, that's a Finance Act 2022's amendment. That's a classic amendment that has a very significant implications in all the other aspects of the trust, about which we'll be seeing a separate example. Scenario number 3, deemed income referred to in section 11(1)(b). If the organization is not able to apply 85% of income in a particular year, then accumulation in excess of 15% is possible. Then Form 9A and Form 10, as the case may be, has to be filed. Then scenario number 4, deemed income referred to in section 11 subsection 3. If the organization is not able to apply 85% of the income in a particular year, then accumulation in excess of 15% possible for 5 years under 11 subsection 2, subject to the following conditions. It is applied for charitable or religious purposes. It is invested in section 11(5) modes and remains invested for a period of 5 years. It is not credited or paid to any other trust or institution registered under 12AA or 12AB. It is not credited to or paid to any other fund or institution under 1023C, 4, 5, 6, and 6A. And the income that is generated in this context is not applied for private religious purpose or religious community or particular interested person. This is scenario 4. Scenario 5, it is violation relating to permissible investments. The income of the trust is invested in modes other than modes permissible in section 11(5). Depositing of funds in impermissible modes, section 139(1)(d) read with 11(5). Scenario 6, benefit to related persons. Income of the trust applied directly or indirectly for the benefit of section 13(3). The last of the scenario, application for charitable purposes outside India. Income applied on activities outside India is not eligible for exemption unless the trust is created before 1/4/1952 or it is engaged in promotion of international welfare in India in which it is interested. CBDT has by general or special order granted the exemption for carrying out such activities. So these are the 7 different scenarios in which section 115 PBA applies. The first of the scenario 1, we have an example for that. Let us see that particular example. This scenario 1, as we saw in the introduction, it is about a scenario where the income accumulated is in excess or the amount set apart is in excess of 15%, where such accumulation is not allowed under any specific provision of the Act. Classic case, shortfall in applying 85% of income. If the income spent on charitable purpose falls short of the 85% of income, then the Form 10 is not filed. For example, for assessment year 23-24, current year donation received is 10 lakhs, 85% to be applied is 8,50,000, actually applied is 7,50,000, Form 10 to be filed for 1 lakh, the Form 10 to be filed before 30th September 2023. The time limit is 2 months prior to date of filing of ITR. The explanation 3 under sub clause A of 1023C says about this. So the amount taxable under 115 BBI is 1 lakh. So this 1 lakh will be taxed at the rate of 30%. The next is scenario 2. For this, we'll have to go to Finance Act 2022's amendment. Finance Act 2022 brought about a significant amendment to explanation 3, 4, 5 to the third proviso of section 1023C, whereby explanation 3 got amended saying that if 85% of the income is not applied wholly and exclusively by the fund, trust, or institution in the previous year, the income is accumulated or set apart for application in the future. Such income is not included in the total income of the previous year, subject to the following conditions. Such fund, trust, or institution furnishes a statement to the assessing officer stating the purpose of accumulation, setting apart, and the period of accumulation, setting apart before time limit under 139(1). The period of accumulation or setting apart should not exceed a period of 5 years. The money so accumulated or set apart is invested or deposited under 11 subsection 5. The period during which the income could not be applied owing to an order or injunction of the court shall stand excluded. So explanation 3 says where the 85% of the income is not applied, then that the balance 15% or the excess amount need not be taxed subject to the following conditions, which is furnishing a statement to the AO, prescribing the relevant facts, and subject to following of the conditions stated thereunder. Explanation 4 says that if any of the conditional exemption given in explanation 3, if that is violated, that leads to generation of income. So this is split into 4 different categories: 4A, 4B, 4C, 4D. 4A is if any income that is there in explanation 3, if it is applied for purpose other than wholly and exclusive to the objects of the fund, trust, or institution referred to under 1023C 4, 5, 6, and 6A, then there generates an income. Then it shall be deemed to be the income of such person for the previous year in which non-compliance occurs. This is scenario number 1. Scenario number 2, where the income referred to in explanation 3 ceases to be remain invested or deposited in any other mode specified under 11 subsection 5. Then in that scenario, it shall be deemed to be the income of the such person for the previous year in which it ceases to remain so invested or deposited. Third scenario, where the income referred to in explanation 3, it is not utilized for the purpose for which it is so accumulated or set apart during the period referred to in explanation 3, it shall be deemed to be the income of such person for the previous year, being the last previous year for which income is set apart, accumulated, but not utilized for the said purpose. Then last category 4D, the income referred to in explanation 3, if it is credited or paid to any trust or institution under 12AA or 12AB, or to any fund or trust or institution or the educational institution or hospital referred to in 1023C 4, 5, 6 and 6A, then it shall be deemed to be the income of such person for the previous year in which is credited or paid to any fund or institution, hospital or medical institution. Here I just want to bring your kind attention to the section, sorry, here I want to bring your kind attention to form 10B and form 10BB, where in the relevant clause we are supposed to mention about the donation made by the trust to any other trust having similar objectives, any other trust not having similar objectives, donation to any other trust that is not registered. So if you are going to give a number in any of those clauses in form 10B and form 10BB, automatically it is a prompter for the application of section 115 BBI. Explanation 5. Notwithstanding anything contained in explanation 4, where due to circumstances beyond the control of the person in receipt of the income, any income invested or deposited as per explanation 3, it cannot be applied for the said purpose, then the concerned trust shall make an application to the AO specifying certain facts and claim the exemption so that explanation 4 does not apply. We'll see a practical example as to how this explanation 3, 4 and 5 has an interplay. Here we have a trust that is covered under 1023C4, whose main objectives are providing free education and plantation of trees for upliftment of environment. It received a sum of 50 lakhs for plantation of tree saplings in September 2022. But according to its estimate, the plantation activity could extend up to March 2025, with rupees 5 lakhs getting applied up to March 2023, rupees 25 lakhs in financial 23-24, and 20 lakhs in financial 24-25. Financial year 22-23. The trust has to furnish a statement to the AO stating the following: purpose of accumulation. Purpose of accumulation in our case is extensive plantation activity and follow-up thereof. Amount of accumulation is 45 lakhs. Period of accumulation is 12 months. Unspent amount invested in post office savings bank is 45 lakhs. Amount taxable for the financial year 22-23 is nil. Financial year 23-24. The trust has to furnish a statement to the AO stating the above extension plantation activity and follow-up thereof, and demonstrating the application of financial year 22-23. The amount of accumulation has come down to 20 lakhs. The period of accumulation has been the same of 12 months. Unspent amount invested in post office saving banks come down to 20 lakhs. Amount taxable for financial 23-24 is nil. This is a simple example. Let us complicate it one level further. Rather complication, let us scale it up one level further. Explanation 4A. The trust fails to apply the funds for specified purpose and spends the same on administrative purpose and transfers the money to person specified under section 13. In that scenario, the entire amount that is accumulated, it will be taxable in financial year 24-25, and the quantum is 20 lakhs, and tax at the rate of 30% on this 20 lakhs would come to 6 lakhs plus the applicable other provisions of Income Tax Act. Then 4B. Here we saw 4A, where the trust has applied for the purpose other than wholly and exclusively to the objects of the funds of the trust. 4B. where the trust withdraws the money from post office savings bank and retains it in financial year 24-25. In that case, amount taxable in financial 24-25 is 20 lakhs. Explanation 4C, where the trust spends only 15 lakhs in financial year 24-25 and the balance 5 lakh remains to be applied. Amount taxable in financial year 24-25 is 5 lakhs. 4D, trust transfers a sum of 5 lakhs to another hospital for treatment of cancer for a patient. Amount taxable in financial year 24-25 is 5 lakhs. Please note that any amount that is being transferred or transferred as donation to any other trust or institution, whether it is registered or unregistered, in this set of conditions, it becomes taxable. Explanation 5. We saw explanation 5. For that also we are having an example. In financial year 24-25, due to the pandemic and a consequential lockdown, the trust could not apply the balance 20 lakhs. The trust makes an application to the AO citing the pandemic and further mentions that it would spend the balance on education of children instead of planting of trees. For the balance of 5 lakhs, the trust plans to transfer the amount to another trust for medical expenses for the people affected by the pandemic. In this scenario also, the change of objects is allowed, but donation to any other trust is not allowed. So the amount that is donated to any other trust for financial year 24-25, amount being 5 lakhs, that amount would be taxable at the rate of 30%. So put it in simple terms, explanation 3, 4 and 5, it is giving a conditional set of exemption. Explanation 3 gives you an exemption subject to conditions. Explanation 4 tells that if the conditions are not being satisfied, then it will be taxed at such and such rate and such time. And explanation 4 gives an rider, gives an exemption from the clutches of explanation 4, wherein if you are able to predict something and that reason happens to be justifiable and subject to all these conditions, explanation 4 would not apply. And again, if there is a violation in explanation 5, explanation 4 would automatically come into place. Once explanation 4 automatically comes into place, section 115 BBA comes into place and the rate of tax is 30%. So that's all from my side, my dear friends. I hope you enjoyed today's video. I will see you in the next video. Thank you.